Hello and welcome to the Look Ahead with me, Fiona Cincotta, Senior Market Analyst at City Index, looking ahead to the week starting the 9th of June. So as always, I'm just going to give you a moment to take a look at the risk warning. I'll put myself on mute whilst you do this. Okay, so let's crack straight on. Just going to start with a quick overview of what's been going on this week. This week we've had pretty concerning data from the US, which has raised concerns over the health of the US economy and also fueled expectations that maybe the Federal Reserve could cut interest rates sooner than initially expected. So as far as data is concerned this week, we've just had the non-farm payrolls today, which were, well, they were slightly stronger than expected at 139,000, but we've seen steep downward revisions of 95,000 from the previous 2 months, which highlights the weakness or a weakening in the US labour market. That came ahead of jobless claims, which have risen to an 8-month high. We also saw ADP data earlier in the week down at levels last seen in 2023. Also, the ISM services PMI this week actually tipped into contraction. So there are signs that the US economy could be moving towards a slowdown. And as a result, we've got expectations in the market that this could mean a rate cut from the Fed sooner than expected, which is having a positive impact on demand for US equities. We've got the S&P 500 trading at that 6,000 level, highest level since I think around, where's this, since mid-February. So that's an encouraging start. Oh, hang on, I've got a fire alarm test going on, but it's okay. So that's what's helped the price move higher. Now, just having a look, that's the S&P 500, and then obviously with the US dollar. Hang on, I'm just going to pause. Okay, so this is the US dollar. Interestingly, we have seen a recovery in the US dollar. Fire alarm still going off, but it's just a test, so no worries. So this is the US dollar. Again, I mean, it's still hovering around weak levels. We have actually seen an increase following the non-farm payroll report, which is interesting given that it's also we're seeing US stocks rise on the back of that. But let's focus our attention on to next week. The key focus next week is going to be on inflation. We've got US inflation. That's going to be what the market will be paying a huge amount of attention to, particularly given the fact that we've seen the jobs data come in slightly weaker than expected. Now, expectations are for the inflation to rise 0.2% month on month in May. That's basically in line with April's inflation. However, core inflation, which excludes more volatile items such as food and fuel, is expected to rise by 0.3% month on month, up from 0.2% in April. Now, this would only indicate a small uptick in inflation, but I think the concern here is that actually the worst is still to come, particularly given the higher import costs as a result of Trump's trade tariffs and as those work their way along the supply chain. So hotter than expected inflation data could raise concerns that the US economy is in stagflation or heading towards stagflation, particularly following the weakening in the US labour market. This sort of scenario we would expect to be actually quite bearish for the US dollar and also for US stocks. So just as far as levels to be watching, this is the US dollar index. It's still below that key 100 level, at the psychological level. We're trading around just over the 99 at the moment. But as far as what to be watching on the upside, you'd want a move above that 100 level in order for there to be a sense of at least stability. At the moment, we have been seeing a series of lower lows. So if we take out the 98.40, that was the low that we saw in June yesterday, then that could see US dollar fall lower. As far as the Nasdaq is concerned, this is the Nasdaq. So we're just having a look. We've moved above this level here. It's extended that recovery from the sort of 16,320 low in April, right, traded all the way up to 21,900. So not that far away at all from all-time highs. We've seen a recovery today. I think there's still going to be a focus on the US the Elon Musk Trump story. I know those two are expected to have a call at any point, but that's going to be still a key theme as we head into next week if we see a continued decoupling, should I say, at the end of the bromance. It does look like it won't be a scenario which continues, but do watch out for headlines, because headline risk is massive at the moment. The market is very much focusing on headlines, which does make it quite challenging to trade. It's not the optimal environment. Traders generally prefer to have sort of, they focus on the economic data in order to be able to plan trades. But obviously with headline risk the way it is at the moment with in Trump's administration, it does make that very difficult because there seems to be sort of new headlines coming in literally each day, which are deciding the direction of the market. So do keep track on stories as well. Headline risk, as I said, that could be key, particularly as well regarding trade. China and the US, Trump and President Xi Jinping had a conversation this week, and the two sides have agreed to start trade talks again, which had stalled. So there has been some encouraging headlines there as well. Now, the stock market has actually recovered quite high towards that all-time high. I think if we get cooler than expected inflation, then that could be the boost that the market needs to get up to back up towards those record levels. So that's what's to be watched out for as far as US is concerned. This is the Nasdaq. So that's going to be the main focus for the US. Obviously, we've got PPI, which is on Thursday. And this is also interesting, Michigan consumer sentiment. Let's just pull up gold here as well. Consumer sentiment has been, the Michigan consumer sentiment has been particularly weak. So the market's going to be keen to see whether that is still the case, or whether we're starting to see some signs of improvement after we move away from the worst case scenario of reciprocal tariffs. There's still sort of quite a lot of uncertainty, I think, as far as Trump and his trade tariffs are concerned. And that has been weighing on consumer sentiment. Are we going to start to see things turning around? That's what the market's going to be looking for. If we see an improvement in consumer sentiment, then I think that could mean that we see gold heading back towards the 3,300 level. That's the level I'll be watching out for. It's the 200, sorry, the 100, sorry, it's the 20 SMA, and it's also the falling trend line support after a failed breakout above the 3,400 level, up towards 3,435 on the upside. which is the May high. If we get a deterioration in consumer sentiment, then that could help or gold prices higher. The other one to be watching out for here is obviously what the inflation data does to the US dollar. If we do see that it sort of fuels those fears of stagnating stagflation in the US, then maybe we'll see that being supportive of the safe haven gold. So that's another one to be watching out for. Just on the upside, as I said, you'd be looking for a break above the 3,400 to get a higher high and bring 34.35 into play. Break below 3,300 opens the door to a deeper sell-off towards 32.00. So other thing that we're going to be looking out for next week, there is a little bit of UK data which is worth watching out for. So we've got, first up, we've got UK jobs figures, which are going to be keenly watched by the Bank of England. Unemployment is expected to tick higher again to 4.6%, up from 4.5%. So that could be indicating some weakness in the labour market. But we're going to find the Bank of England is going to be massively watching out for wage growth. Wage growth in the UK has continually remained persistently high, and it's not at a level that is consistent with inflation cooling back to the 2% target. So wage growth, wages grew by 5.6% excluding bonuses in 2025. In March. So that's, again, not consistent, as I said, with the 2% target rate for inflation. The Bank of England have said that they want to see wage growth cooling before they cut rates more aggressively, because wage growth is intrinsically linked to sticky service sector inflation, which again has remained particularly high. At the moment, we've had Bank of England Governor Andrew Bailey saying that he's very much sticking towards the gradual and careful approach to cutting interest rates, which has supported the pound. It's kept the pound well supported against the US dollar and the euro as well. So in fact, we had the pound trading at multi-year highs above 136 just yesterday. So yes, we've got that data. If we see sticky wage growth, then that could actually see the pound push higher, because it's going to fuel those expectations that the Bank of England won't be able to cut interest rates. If we see a fall in wage growth and rising unemployment, then that could see the pound fall lower, as it will raise expectations that the Bank of England may be able to start cutting interest rates more aggressively. As well as UK jobs data, we've also got UK GDP figures. Don't know why they're not on there, but we do have it on Thursday. UK GDP, that's basically, we had a really strong growth in the UK at the start of, in the first quarter of the year. It was growth of 0.7%. However, that strong growth was not expected to continue across the year, owing to basically the turmoil caused by Trump's trade tariffs. April GDP is expected to rise 0.1%, and that was after a 0.2% growth month on month in March. Now, the data comes after the OECD downwardly revised UK economic growth in the UK to 1% next year. And as I said, Bank of England so far, they're still looking at its gradual and a careful approach to cutting rates. If we do see slowing growth or unexpected contraction, then that could pull the pound sharply lower. Levels to be watching out for on the downside, 134.30. That sort of seems to be a level that was the high that we saw, 134.50, sorry, the high that we saw in April, and it's sort of around the lows that we saw in June. So if we're going to break below that and 132, that opens the door to, sorry, and 134, that opens the door to 133. On the upside, strong data, strong GDP growth, sticky wage growth, watching for a move above the 136.15 level. That will create a higher high, bringing 137.50, a level that was last seen in 2022, back into play. So that was the pound. I'm just going to bring up the FTSE as well, but just before we talk about the FTSE, it's worth also keeping in mind that we do have some China data. The FTSE can be influenced by China data as well. So, but let's just have a quick look at them when we move on to China data. FTSE 100. Here we go. FTSE 100's been really helped higher. We've pushed above this resistance level that has been proven to be a little bit tough around the 8800. But look at this recovery. I mean, we're seeing the FTSE recover even when there's been a bit more of a stalling in other markets. We've seen it's tracking the 20 SMA higher, risen above the 8800, looking towards the 8910. That would be the next level to be watching out for, which is also the record high. So if we get our encouraging data, then we might find that that helps boost the FTSE. But also it's worth, as I said, keeping an eye on the China data. If we find we've got Chinese inflation figures due out on Monday, expected to show disinflation continuing. If we do find we get weaker than expected Chinese data, that could have a negative impact on the miners, the heavy-weighted miners on the UK index. That's something to be watching out for. As far as support is concerned, I mean, the next sort of level, we've got the 20 EMA there, it's 87.50. Below that, we've got 86.50 on the downside if we do find any weakness. But we've had a solid recovery from the FTSE 100. Also, we're just going to have a look at USD Japanese yen because we have Japanese GDP data as well. This is on Monday to be watching out for. Expected to show it's not the first reading, it's not the preliminary reading, it's secondary reading, so it does tend to be a little bit less market moving. But considering that we saw a contraction, it is something that's going to be in focus. Obviously, we've had Bank of Japan's Governor Ueda has highlighted concerns over the ongoing trade tariff policies and the impact on the Japanese economy. Now, we've seen this recovery in the US dollar, and that's showing through in this US dollar Japanese yen, pushing it above that 50 or testing the 50 SMA there around the 145 level. Just found support, a resistance at that 145 level. Now, if we get weaker than expected or a downward revision to Japanese GDP data, then we could find a push towards that 148.65 level up there, and that would then expose the 200 SMA around the 149 level. So on the downside, this is the support zone that very much held across the May period. That's on the 142.50 level and 142. So they're the levels that we're going to be watching for on the downside. If you get a break below there, then you will be seeing a move towards the 140 level. We'd expect that to happen if we see a ramping up in rhetoric surrounding the US Trump trade war. If there are any new announcements, then that could see that level taken out. And also, if we found cooler than expected GDP data, then that could also, CPI, that could also see that pair come under pressure. Hotter than expected data could be looking for a move higher. And just finally, let's take a look at oil. Oil it still continues to trade within a relatively tight range, but we have seen a rise above the lows at sort of just around that 60, just below 60 level. We've been again tracking the 20 SMA higher, moved above the 50 SMA, looking towards that 65 level next. Now that we sort of appear to have taken out 64 resistance, and that opens the door to 65. What to be watching here? I mean, US data, China data also tends to have a big influence on oil prices, as well as sort of any news around US-Iran trade negotiations. But the RSI is showing that momentum is positive. So that's the next level I'll be looking for. 65 could be a tough one to break above given the falling trend line resistance. Okay, so that is everything for this week. I hope you found that useful, and I look forward to seeing you again next week.